What's up, YouTube? It's Todd Horst here with Stacy Tracker. Today I want to talk about options assignment. It's one of the scarier parts of options. You're not really sure whether that applies to you and what that really means. Anyway, so I thought I'd talk about that today. Real quick, sorry about last week. I've been working hard on a new watch list that I think is the best watch list you'll probably ever interact with, hopefully, and I'm hoping to roll that out in the next week or two. So check out or watch out for a video coming out on that as soon as I'm finished. So anyway, so first of all, let's get some perspective, and I'll walk you through what assignment means and how it happens, and I'll try to do it as quickly and simply as possible. But starting first, you need to have some perspective here and some context of what everything surrounding this deals with. So a bank doesn't want you to default on your mortgage. They would much rather work with you to get your payments lowered or something like that so that you can continue to make payments. And similarly, a broker doesn't want to margin call you because you might not actually have those funds, and it's a big hassle for them to take you to collections or something like that. Obviously, it's way easier and cheaper from their standpoint to do everything in their power to prevent it from getting to that point. So that's one of the reasons why there are approval levels for options. And so you typically start off being able to only buy calls or options, and then you can go the whole way through to the highest level where you're able to sell naked calls, and that it all deals with risk and undefined risk. So buying a call or a put, you know exactly how much you're going to lose. When you're selling a naked call on the complete other end of the spectrum, you never know exactly how much you could potentially, as a person selling that call, how much you could potentially lose. And so if you think about this, if you are buying a call, you want the stock to go up. If you are selling a call, that means you want the stock to go down. But what happens if it's not going in your favor and the stock goes up? It could go the whole way to the moon, to infinity, and now you owe more money than you could ever make in a lifetime. So that's sort of the risk, and you need to work up to that level and to that understanding. Obviously, in reality, it's not going to go to infinity, but it could go higher than what you could handle. And so that's why you don't get approved for the highest level unless you have demonstrate experience and the knowledge of what you're doing. So let's get into what a margin call is, because I threw some terminology out on that first slide. A margin call is simply when your broker doesn't have enough money in your account to cover your positions. So it might not be that you got assigned anything. It could just be that you sold a naked call or put. And the way it works is they'll estimate how much collateral you're going to need in your account. But as things move up and down, they might say, you know what, we thought it was going to be, we were going to need $1,000 to feel safe, but as a broker, we don't feel safe anymore with just $1,000, and we're going to need $2,000. So if your account has $2,000 in it, no problem. You're still within your the necessary financial requirements there to supply that collateral. However, if you only had enough to cover that initial $1,000, now your account is essentially going to show a negative $1,000 because they upped their margin requirements, and then they're going to do a margin call, which is saying you need to deposit more money or close your position. So those are the two sub bullet points here, and closing the position is the easiest and most common because Not everyone has a lot of money sitting on the sidelines. Sorry, I just ate supper. That they can just deposit in. The downside clearly there is that the position wasn't intended to be closed, and so you're forced into it. So you're going to take a loss on it, even though it still might come around, and you would have normally left it on, but they're forcing you to close it. Of course, they're not forcing you to close it. You could also deposit more money to cover the new margin requirements. Okay, so the next bullet point here is many times you won't even get to that point because each broker has a risk assessment team. They look at all of your positions and they get notified if something pops up that matches some criteria. And some of that's how much money you have left, some of that's how much experience you have, and whether the position is getting close to being assigned. Robinhood's is especially proactive. There's a lot of horror stories where Robinhood will close out the position and they'll do it for a loss, or right if something's right on the bubble. They're typically going to use a market order to get that filled. They're not really concerned about how much money you lose. They just want the position to be closed with as minimal impact as possible. So the reality is, again, if it's on the bubble and maybe 10 minutes later the stock shoots up or down or whatever direction you were playing, and it went in your favor, well, Robinhood looked at it and thought it was too risky, and so they closed it out. Other brokers like Tastyworks, who is the broker that I use, for your first couple positions, they'll send you notifications that hey, you have something that's at risk of assignment here, and if you want us to, we'll close it for you if it becomes close to being an issue. Or they might, or you can email them and say, hey, look, no, I'll monitor the position, don't do anything with it. And then I think as time goes on, they still notify you, but their default stance is to assume that you're a professional and know what you're doing. But you can always tell them, hey, go ahead and continue to proactively close my positions if it gets close. But following to the rest of that bullet point, Robinhood is so on top of things, typically speaking, that they will not allow you to even open up 0-day positions. So those would be positions on the expiration Friday where they expire that Friday, and it is that Friday. On Tastyworks, I can still open up a position Friday morning that expires at the end of the day on Friday. But on Robinhood, it'll say, it won't even list that position as something that you can enter into. And if you already have that position, it'll say you can't open up any additional positions. You can only close this position. So Robinhood is so stringent because they're targeting newer customers who don't have the experience with options, and so that's why they're trying to stay on top of it to limit their risk of something going negative by a large amount, and then they would be on the hook for the money essentially because the user doesn't actually have the money to back that up and compensate Robinhood. So sort of the next thing I wanted to talk about was exercising an assignment. For Robinhood, there are no fees, so exercising an assignment really doesn't mean that much with how you deal with it, whereas other brokers have fees. So you want to be a little bit more proactive in trying to not get assigned, to at least reduce your risk. But even if it does happen, you'll get the $5 or $10 fee, whatever it is, and it's not the end of the world. But if you want to be as cheap as you can with commissions, then you're going to want to close out the positions that are likely for assignment as soon as they sort of cross that threshold. Okay, so what is that threshold? you can only get assigned if you sell a call or a put. So most people, when they're starting off, they're selling covered calls, which they have the equivalent number of shares of that equity, and so those would get called away. Or they're buying calls and puts. So those are the sort of two most common ways people get started. And with buying calls or puts, you never have a risk of assignment. You do have the choice to exercise, as you see at the end of the bullet point there, but you don't have to exercise. Although I think by default they'll exercise at expiration. If you don't close out the position, it's assumed that you want it, assuming you have enough capital to buy those shares. Again, if it came time for expiration, you had a call that was in the money, but you didn't have enough money in your account to purchase 100 shares of that equity, Robinhood would close that position, and you would still make money on that position. And so you just might not make as much money because they may not close it at the exact moment that you would close it. But who knows, maybe they close it at a better time. So, but anyway, buying will never, ever, ever result in assignment. So until you get into selling spreads or verticals, whatever you want to call them, or selling naked, you don't need to worry about assignment. Typically, you will only get assigned in the last week. And I do have the word early assignment because it's not assigned at the time of expiration. So you'll typically only get that in the last week if it's way in the money. If it's on the edge, on the bubble, and it keeps flipping in between being in the money and out of the money, you're typically not going to get assigned until it's a day or two or the day of expiration, if at all. And once it does hit expiration after hours on that day, it's sort of between that day and the Saturday, assuming we're dealing with weekly or monthly expirations, is when you'll see all of the transactions occur where the position will be removed from your account, and you'll see the shares in your account now. That you'll only be assigned if it's in the money. But if it's right on the edge and then last minute before the close on Friday, it goes out of the money, you're fine, and you will have gotten to keep all of the premium that you collected when you sold that position. And so the next bullet point is, why will it take so long? Or let me just say one last thing with that. Just because something goes in the money, or maybe I'm just reiterating this, just because something goes in the money does not mean you will be assigned. So if you're 3 weeks out and your position goes in the money, you'll be fine. Nothing will change about your position. There's always a chance somebody could exercise their position, whether you're in the money or out of the money. But there's a very, very little chance that that's going to happen because it doesn't make sense. So now we'll move on to the next point. The reason you won't get assigned is because if the call or put that you sold is out of the money, you can get a better deal by just purchasing the equity outright. And the next bullet point, you won't get early assignment if it's in the money, because there's remaining extrinsic value. So again, 2 weeks before expiration, there's extrinsic value, which we'll get into in a later video, but there are all the Greeks that give it position additional value, that if they do exercise, they'll be throwing that extrinsic value away. And an easy way to think about this is there's just additional money to be made. There's money they would be leaving on the table that, say they bought a call at $100 and the stock is at 105 right now, and there's a week left to expiration. They could exercise it now and collect that $5 difference, or they could wait till actual expiration and maybe it jumps up to 130, and so they missed out on $25 of premium that they could have collected if they would have just held on to the call. So they're motivated to hold on to that as long as possible and hope that it continues to move in their direction. Okay. And so historically, I know I've experienced about 1%, maybe even less than that, of my positions that have gotten assigned. And I know that's pretty standard. So yeah, you're talking about one position out of every 100 positions you open. So it certainly doesn't happen that often. It's not a big deal. And it really has no impact on your account. So what's the advice if and when you will get assigned? Because if you're, again, if you're selling spreads or naked, you will get assigned at some point. So take a breath and realize everything's fine. It's not going to be a big deal. You can call or chat with your broker depending on their support level. That is one reason to go with a better broker. Where Tastyworks, I can call them up on the phone or have a real-time chat. Robinhood, at least it used to be, I'm not sure if it's still anymore, was email. And so they were slower to help. But anyway, there's tons of documentation out there on how to handle it for the broker platform that you're on, the specific buttons you need to click. But the general process is the same everywhere, and it is very easy. So for the first time or two, I would just get a hold of your broker the next day, the next business day. So that would be on Monday, assuming that it expired on Friday and you got assigned. And then you see your account reflecting that on Saturday. Sometimes it doesn't show up correctly until Monday. So sometimes your position will still show, but then you also see the stocks associated with that assignment. And so both are in your account at once. And that usually just takes a minute to clear out of the system. So, Monday by 10 o'clock, things should be getting close to normal. But anyway, the first time or two, I would just talk to the broker anyway, just so you know exactly how to handle it. And that's what you're paying for. Whether you're paying literal commissions or not, Robinhood still makes money off of you, and so you deserve to get support. But anyway, understand you'll be fine. You're not going to lose all your money. You're not going to lose your house. They're not going to come and take anything from you. Everything will be normal. And I do have some qualifications there, assuming you didn't use the Robinhood hack or other measures to circumvent the system. So you did everything normal, that you weren't trying to cheat. The other thing is, if you didn't lie to get the approval levels and you worked up on this understanding. Now, they're not going to give you a lie detector test or anything stupid like that. My point there is, if you've been honest and you know somewhat of what you're doing, they're going to work with you, again, because it's in their best interest to make sure that everything settles out normally. So to remedy the situation, the next business day on Monday, you have all day to get things situated. So it's not like you need to be there at 9:30 to make sure your account gets fixed up. Like I said, it will take a minute for everything to settle down in your account anyway. But you have all day. I wouldn't drag it out for multiple days. I would get it situated that day, but it's not a big deal. Okay, so assuming that this entire discussion has been assuming that you don't have an account size big enough to purchase the 100 shares. But maybe you're lucky, you have a lot of money, or maybe you're trading a stock that is pretty low value, and maybe you do want to take the 100 shares, or your account can support it. So if your account size can support it, Robinhood's not going to automatically close out your position, because to them it looks like you did this on purpose. Okay, so if your account is big enough, you can simply hold these shares and wait till it's a better time for you to sell those shares or buy the shares, depending on whether you bought to open or sold to open, which we'll get to the difference in that in a future video. But there's strategy called the wheel, which this is how you start off the process, where you sell to open a position, collect that premium, then you could get assigned. You get the stocks either long or short, and then you start selling covered calls or covered puts, and you just repeat that process over and over again. So the very last bullet point here is you can maintain that position, which at the moment is a loss, and still win in the long run if you wait until the market moves in your favor. So especially with a lot of the ETFs, they're cyclical. So it's not always a bad thing to get assigned and just hold the stock if you can, especially assuming you own Robinhood where there aren't any fees. But even if there are fees, you can make up that and more just by holding on to the position. Okay, so that's really all I had. So just to reiterate, if you get assigned, you're going to want to go in the next day, talk to your broker, and all you're doing is selling these stocks back that you were assigned. And even though you don't have the money in your account technically, it'll show up a negative value. So I haven't been assigned for a couple months, but last time I was assigned, my account showed as like a negative $2,000 or $3,000, and everything else functioned fine. There was the account was in red at the top, but all I did was sell the stocks that I had been assigned, the 100 shares, and then my account went back up to the value it had been prior to the whole assignment process. And again, I think that whole process before everything shook out, and it took like 2 or 3 hours, so my account still showed up negative even though I had sold the stocks back, but that's largely dependent on your broker. So that's one option. You can, I feel like I had another slide here and it's not here, but anyway, so you can sell the stock back. That's one. The other option is to exercise your other position that you bought. So that's assuming you do the spread. So if you sold a call and that's the leg that got assigned, and then you also bought a call to cap your profit or loss, then you can just exercise that one. Again, I would only do that really on Robinhood because there are no fees. But if you're going to do that on Tastyworks, then you'll kind of get two fees. You'll get the assignment fee for the sold call, and then a exercise fee for the bought call. So I wouldn't do that route. I would just sell the 100 shares outright if I was on Tastyworks. And the third choice is that you can just keep it if you have enough money in your account. But the whole point here is it's something that happens very rarely, and it can be mitigated by monitoring your positions to see when they go in the money, and when they get the week of expiration, if it's still in the money, consider closing it. If you don't have a large account, the broker will close it for you. So with all of that said, obviously if you have any questions, you can comment down below and I'll respond to you. I have a video coming typically every Friday, and my website is tastytracker.com. We're an options tracking website where you can track your personal trades. I will in the future very shortly have a watch list that gets updated every night, and has several hundred stocks or equities to choose from. They're going to be the best of the best, and that's tailored to you. So if you're into investing in dividends, we'll have the best of those. If you're into ones that are on a really good bullish trend recently, we'll have those for you there. If you're into a long-term sort of 52-week gainers, we'll have those. So yeah, we'll have just the best of the market, and we'll have about 500 every day, somewhere in that range, and that will change every day, and it's all automated. So it's not my personal picks, but scouring and scanning to get the best list. But Anyway, I have a free demo, so you can go check it out, and it's only $9.99 a month. This is only for educational and entertainment purposes only, so don't take this as financial advice. Anyway, thanks guys. See you later.